Welcome to The Explainer. Today, we're digging into the one question that seems to be on every investor's mind. With AI valuations going through the roof, are we just living through a repeat of the dot-com bubble? Let's start with a number, a huge one, $5 trillion. That's the estimated market value that was just completely wiped out when the dot-com bubble burst back between 2000 and 2002. It's an almost unimaginable amount of money. And the fallout was just devastating. Thousands of companies went under, the Nasdaq plummeted 78%, and it took 15 long years just to climb back to its peak. This crash didn't just erase fortunes, it totally reshaped the tech world and left some deep scars on a whole generation of investors. Which, of course, brings us to today. The parallels are pretty hard to miss, right? You've got stocks skyrocketing, you've got massive amounts of venture capital flooding in, and there's this feeling of, mania in the air. So what's the deal? Is this just history repeating itself? Let's dive into the evidence. All right, first up, let's just set the scene. For anyone who remembers the late 90s, the excitement around AI right now feels eerily familiar. It's creating this powerful sense of financial déjà vu. I mean, just look at the sheer scale of this surge. Back in the day, the Nasdaq climbing 400% was mind-blowing. But Nvidia, it's rocketed up an absolutely staggering 1,300% since late 2022. That doesn't just dwarf the 90s boom, it blows it completely out of the water. Okay, so the frenzy definitely feels the same, but do the underlying numbers tell the same story? Let's really compare the core financial metrics from the dot-com peak to what we're seeing in today's AI boom. And right away, we see a crucial difference. Valuations today seem a lot more grounded. At its absolute peak, the Nasdaq was trading at a forward price-to-earnings ratio of about 60. Now, what that means is investors were willing to pay $60 for every single dollar of expected future earnings. Pretty wild. Today, that number is less than half of that, which suggests a much tighter connection to actual profits. However, and this is a big one, there is one major alarm bell ringing, and that's market concentration. Today, the top 3 tech giants make up an even bigger slice of the pie than their counterparts did back in the dot-com era. This is a key risk, because it means our entire market is really reliant on the performance of just a handful of winners. So beyond the broad market numbers, what about the companies themselves? Was the dot-com era really just built on hype and promises? Well, the AI boom is built on real, profitable businesses. Well, the data here is pretty stark. It's like night and day. Back in 2000, only about 14% of tech companies going public were actually profitable. Today, the giants leading the AI charge, we're talking Nvidia, Microsoft, Google, they are absolute cash-generating machines. I mean, the dot-com era was basically defined by these cautionary tales, right? Companies like Pets.com, which famously burned through hundreds of millions of dollars with absolutely no realistic way of ever making money. Now, you compare that with today's market leaders. They're not just selling a dream. We're talking about proven, highly profitable business models that are generating real, tangible value. This is a world away from the dot-com era. But, and this is a big but, here's the nuance. While the leaders are incredibly strong, a lot of the new AI startups are unprofitable. And their high burn rate, that's that classic dot-com term for how quickly a company burns through investor cash, is a definite echo of the past. So that speculative risk, it is still very much alive and kicking. Okay, let's zoom out a little bit. What about the world surrounding the technology itself? Let's compare the investor hype versus real-world adoption then and now. So on the hype front, there's a ton of it. A recent survey of global fund managers showed they're almost split right down the middle on whether AI stocks are in a bubble. That tells you just how contentious this whole thing is, even among the pros. But hype aside, this is where it gets really interesting. The adoption is real, and it is widespread. Back in 2000, the internet was still kind of fighting to get traction in the corporate world. But today, AI is already deeply integrated, with nearly 8 out of 10 organizations saying they're already using it. And this brings us to what might be the most crucial lesson from history. The story of the internet, the narrative, it was absolutely correct. It did change the world. But the investors who bet on that change happening overnight, they got burned. And that exact same risk applies to AI today. So after all that, what's the verdict? Based on all this evidence, what does the future hold? Are we heading for another catastrophic crash or something else entirely? Well, history would suggest a full-blown systemic crash is pretty unlikely. What seems more probable is a significant correction. A scenario where the weaker companies fail but the strong ones survive, consolidate their power, and actually come out even more dominant on the other side.
So the big takeaway here is really nuanced. Yes, today's AI boom is built on a much stronger foundation of profits and real adoption, but the speculative froth is also undeniable. And here's a surprising stat from history. About 48% of dot-com companies actually survived the crash. It's a powerful reminder that even in a bust, real value can and does endure.
Which leaves us with a really fascinating final thought. Maybe all this mania, this irrational exuberance, maybe it's a necessary ingredient. It's what unlocks the massive amounts of capital you need to build truly transformative technology, even if a lot of that money gets lost along the way. Maybe a bubble isn't a bug, but a feature of profound technological change.
Always remember to do your own research. This is not financial advice.